Hello everyone, welcome back to the channel. This is DILEEP. If you had been in trading, you would have understood by now it's very crucial for a trader to understand where the trend reverses. A critical leading concept in this context is order flow absorption. Order flow absorption provides valuable insights into potential trend change. Here in this video, we'll be discussing how to identify this buyer and seller absorption and how to make use of it to understand where a trend changes. So what is absorption then? Think stock market like a tense tug of war between two teams. Typically, when one side exerts more force, the rope moves noticeably in their favor. However, sometimes you might have observed, even though one side continues to pull, the rope barely shifts. This subtle resistance indicates that the opposite side might be quietly absorbing the pressure, potentially leading to an eventual reversal in the rope's movement. Now, consider buyers and sellers in the place of two teams and price representing the rope. At first, buyers or sellers will flood the market. So in this case, let's say sellers flood the market with sell orders. And at some point of time, despite of heavy volume coming into the markets, the prices doesn't move. So this we call it as absorption. So what is happening here is whatever the selling is coming in, that is being absorbed by buyers. Core principle in understanding market absorption lies in understanding the cause and effect between the order volume and the price movement. So let's see, what does it mean? So to understand absorption, it's very crucial to understand how orders gets executed in the live market. So this is how a DOM looks like. So DOM is nothing but the limit order book. So here I have taken Bank Nifty May futures because spot price doesn't have any kind of orders in that. It is just nothing but an index. Whereas in Bank Nifty futures, we have volumes. So let's understand what is it. So in this DOM, this is 5 DOM, depth of market, limit order book. So the first one is the best bid. This is the highest price buyer is ready to buy. This is the lowest price the seller is ready to sell. 48,216 is the best bid and 48,218 is the best sell price. So the difference between this 16 and 18 is nothing but the bid ask spread or market maker spread. So we don't want to go into that, but let's understand how an order gets executed here. Now these are called as resting orders. Why resting orders? These are in the limit order book resting. I'm sure you will be knowing there are two types of orders. One is market order, one is limit order. So these are limit orders. As I said, these are also called as the resting orders or passive orders. So when the price moves is when a order gets hit these prices. It could be because of limit order or a market order. So let's say if I specify 48,216.05 in the limit order book, in the limit price, and if I throw that order, it will get executed at this price. Same thing, if I place a limit order by specifying 48,218, it will go and execute at this price. So here is the interesting thing. Unless the buyer or seller is in urgency, the buyer always want to buy at lower prices, the seller always want to sell at higher prices. This is how a market works. So here what happened, this is 48,216. I placed a limit order specifying this order, or I might have placed a market order. So in market order, I don't specify any kind of price. The moment I place a market order, it will go and execute at this price, hitting the bid. So here the quantity is only 15, which means that there is only one lot. So let's say I placed a sell order of 3 lots. So here the third lot is somewhere around 48,213.90. So the moment I place a market order, the price gets hit. First will be taken out because it gets executed. Second will be taken out, which is 0.05 paise lesser than the first one, which is 48,216. The next limit order is at 48,213.90. So my average will be somewhere in between this because all these 3 orders got executed. So now the prices have come down a little. So this is how the price moves in the market. The market orders which are hitting the best bid or best ask prices, they are also called as aggressive orders. So remember this throughout the video. These technical terms are very important to understand how the absorption happens in the market. Let's get back to the absorption of selling orders. So let's say, for example, when a seller comes continuously, the absorption of sell orders comes when there is a market limit order, also called as passive buy orders from the opposite side. You also know that for every sell order, there will be a buy order. So what moves the price, as we discussed before, it's the market orders or the limit orders, which are specifying the best price. So if there is a buyer stronger who had, let's say the seller has a 1 lakh selling quantity, but the buyer has a 2 lakh buying capacity, he placed a limit order in the system and the prices continuously hits this limit buy orders, but the prices won't go down because this buyer is more stronger than the market seller. So the prices won't go below this. That's how the absorption happens. Whereas absorption of buyers happens because there is a limit seller who is much stronger than the market buy order. So let's say this buyer has 1 lakh buying capacity, whereas the limit seller, he might have 2 lakh selling capacity. So this limit seller, it could be because of two types of business. It could be old business, it could be fresh business. So let's say this limit seller, he might have bought at lower levels now of 2 lakh quantity or 3 lakh quantity, but the buyer, market buyer who is buying, maybe retail trader or whomever it is, they have only buying capacity of 1 lakh. So he keeps on buying, thinking that the prices will go beyond, but the price is not moving past that limit order because he had purchased much lower prices, and this person might have hedged his positions above the level where he is supplying. So he keeps on supplying it. Now let's say another buyer comes and he is more powerful than this limit seller who is selling at 22,270. The prices might go further beyond this limit seller. Let's look at some other example. The first signs of absorption here, it has started somewhere here. The price and volume, they are not matching equally. So continuously the price, sellers are selling 4.4K is a very strong selling volume, but at the same time, the price is not closing at the lows. So the effect is not equal. Also remember this, there are two ways absorption happens in the market. First way is a gradual absorption. What does it mean is, so let's say as the prices goes down, absorption happens continuously at multiple levels. So let's say here one institutional comes, he absorbs something and the prices comes down further, he absorbs further. And at some point, there will be more number of institutionals forming a tipping point where the prices stops making lower low and it starts making higher highs. Since the price is making continuously lower lows, we can safely assume that sellers are still in control. But look at how the prices are reacting. So for 4.4K, the prices have moved almost 80 points, but whereas when it comes to here for 3.8K, which is more or less equal to this, the prices have only moved 50 points. But not only that, look at how the price is closing. Continuously, the price is closing above the absorption levels from here. Look at this. Continuously, passive buyers are absorbing the aggressive sellers. Once the previous high has broken, this could be a turning point. So let's look at some other example. This is also a beautiful example here. You have good amount of absorption here. So on right side, this is a gradual absorption. So I told you before, there are two types of absorption. One is gradual and one is sudden stop of prices by a single big institutional order, passive order. So here continuously, gradually it has been stopped. The prices are closing below the absorption levels. So let's look at some other example. Look at here. Despite of strong selling, the prices closed above the absorption levels. This is a sign that the control of markets might have changed from sellers to buyers. So understand this, for each and every buyer, there will be a seller. So at each and every level, there will be an absorption taking place. But the point is, what you have to do is where the major orders are getting absorbed. That is where the tipping point happens. It's not that 300 orders, 121 orders, 300 orders, 440 orders. They are also absorbing something, but do they have the capacity to turn around the markets? Maybe in very rare cases, but not all the time. It's the strongest institutional traders who changes the trend. Look for this kind of absorption. Now, very important thing is you need to understand where this absorption level happens. So mostly this absorption level happens during value area high, value area lows, day high, day lows, HVM zones in volume profile, or previous supply zones, previous demand zones. Those are the areas you will need to watch for. So look at this, previous swing low is there, prices made a higher high, and then at the same point there was a absorption here, 1.5k. There is a strong supply from here to here. Around that there is a good absorption of buyers. So the prices went down again. So always draw these levels. So there is a good demand zone here. So around the same point, there is a good absorption that has happened here. Good absorption. This is with absorption, guys. For more order flow insights, subscribe to the channel, turn on the notifications. Thank you. Have a nice day.